Good evening, everyone, and welcome to our webinar on Stop Donating to IRS. For a long time before I became a real estate investor and business owner, I have been fascinated by how the wealthiest in this country pay the least amount of taxes, while the hardest working middle class in full-time jobs get hammered with taxes. You especially know this if you're living in California, because you pay the state taxes besides paying federal income taxes. Being in a full-time job, 9 to 5, I realized I was giving away a lot of my income in taxes. And as I made more and climbed up the corporate ladder, I paid more and more in taxes. So I really saw how taxes were eroding in the growth of my wealth and my savings. So I think this is a very important topic we all should be talking about more. And I wanted to bring a very accomplished guest speaker today to talk about this, because you really need to worry about reducing your tax burden for true wealth creation and to reach your financial goals sooner. I'm excited to have Angie on today. She is a California-based CPA, certified tax consultant, and certified tax coach who loves to help businesses and individuals save thousands of dollars by employing IRS-provided advanced tax reduction strategies. Small businesses and individuals must be proactive about managing their taxes, because major corporations always have access to all these strategies through large legal and tax departments. But Angie is passionate about bringing such services to us within the reach of a small business owner so that they can put more of their hard-earned money back in their pockets. Angie specializes in serving real estate professionals and investors, self-employed healthcare practitioners, as well as dentists and dental practices. I'm very excited to have Angie on today, and I'm going to hand it off to her. But before that, I have a few housekeeping items and disclaimers and stuff like that that I need to cover, and also a few webinars, upcoming webinars, and I'm going to give it off to Angie to do her stuff. So a quick disclaimer here, everything provided in this presentation is for educational purposes only. Of course, we have a very qualified CPA talking today, so she knows what she's talking about, but always consult your own financial advisor or CPA as appropriate for your specific tax situation. Angie will also share with us her information after this webinar or during this webinar, so you can call her or set up an appointment with her if you're interested in talking to her further. So she can talk about your specific tax situation. A few housekeeping items. I know that someone said they're on mute. Yes, it's purposeful. I have 83 attendees. I can't have everyone speaking, so everyone's on mute. If you have any issues with audio visual during the webinar, please let me know in the chat box so I can fix it. Also, please locate the Q&A box. It's on the top bar of your Zoom application or in your browser at the bottom. And please use that Q&A box to ask any questions. It just keeps it a little bit more methodical when we're going through the questions to answer them. And we make sure we don't miss it, because chat boxes kind of tend to be very chatty and I can't really keep track of it. I record this webinar and I send a link out to all the attendees within 24 hours. So if you want to get a recording and you want to basically follow up on something that I've missed here, please add my email, kavita@cherrystreetinvestments.com, to your contact list to prevent it from going to spam. A few upcoming webinars that I'm excited to have on this September, this month. I have an investment opportunity webinar on September 17th, which is next Thursday. And usually I try to do this on Thursdays unless I have to accommodate someone's schedule. September 17th, same time, we will be talking about the newest investment opportunity. I will be sending out an email later this week if you're on my investor list. Also this month on September 24th, which is the following Thursday, at the same time, we have two experts, a Houston-based IRS consultant and a Mumbai-based chartered accountant, will be talking about your investments in India. A lot of us have either bought investments in India, bought properties, or inherited properties. So You can come learn about all the tax filings and implications of owning property in India, and how you need to handle that. If you want to figure out how to sell it and repatriate the funds here with the minimum capital gains taxes, these are the guys you need to know. So please join us for a webinar if this is relevant to you. If you don't have investments in India, maybe you're considering foreign investments, this will still might be relevant to you. So feel free to join us if it's relevant to your investments in abroad outside the US. In October, we have, I took a long time to nail this one down because I had all trouble getting all these 3 successful people together in a room or for a webinar. So we have a panel discussion called Penniless to Success. We have 3 immigrants who came here with nothing, financially freed themselves from their jobs to start very successful businesses. If you want to learn how they did it, what they did, and to be inspired by these people, please join us October 8th, which is again the following Thursday at 7:30 p.m. Actually, 2 Thursdays after. So another free event that I wanted to talk about is there's a tax protection, tax and asset protection workshop that Anderson Advisors is putting up on Saturday, September 12th. It's all day long, 9 to 5. So it's more like a boot camp session. The registration link is bit.ly ABA, which is Anderson Business Advisors -free-bootcamp. If you're interested, please do sign up. I will share an email with the recording of this webinar plus a link to this registration if you're interested in joining them. A lot of folks know me, but there's a lot of new folks on the call today, so I'm just going to quickly introduce myself. I'm Kavita Barthake. I moved here from Bangalore, India in 1998. I did my master's in computer science from A&M, and I was in technology for almost 20 years between Wipro, IBM, and Atlassian. I have been a real estate investor since 2009, and that's kind of what got me on this journey. And I financially freed myself and transitioned to being a full-time entrepreneur last year. I founded and manage a company called Cherry Street Investments, and this is what I do. A little bit about what Cherry Street Investment does, and you know, my messaging can get complicated, but I help people find passive investments in real estate. I help them, I and my partners, we help them look for active investments in real estate, whether it's single family or multifamily. As far as passive investments, I'm focused in multifamily apartment buildings and senior living. I also help people, I have a team of folks who are doing life insurance, high yield banking using life insurance. It's a specific concept called infinite banking. What we do is we actually use these life insurance policies to invest into real estate and make other investments as well. As a company, I'm very focused on education, and hence this webinar and all the other educational offerings that I put together. You can follow me on YouTube. I put all these webinars, all short videos, and everything related to investor education, as well as education for teenagers on financial education for teenagers. All of it is on the YouTube channel. Please subscribe, and so you can get updated when I put in new videos and new content on this channel. I also run a group called Purely Passive Investor Group on Facebook, and that's education focused again. It just serves as a community to bring all these passive investors together and get educated. Our guest speaker today, I'm super happy to bring here Angie, and a little side story about Angie. So Angie attended a few of my webinars, and we had some complicated questions about some really nerdy specific tax issue. And Angie answered that in the chat box. And I'm like, I need to unmute this lady to have her come talk on this webinar, because she knows a little bit more than the speaker knew in that case. So I'm super excited to have Angie here today. She is a professional speaker. She speaks at conferences and mastermind meetings and shares all her insight into tax savings. She's the founder of FinTax CPAs, which is an industry-leading advisory firm focused, as I mentioned, on individuals and small businesses. She lives in California with her family, her amazing husband, and I think he's logged in. Hi, Harinder, and two beautiful daughters. She is a foodie and loves to go for long walks, listening to favorite podcasts on taxes. I just cracked up hearing this because I'm a super foodie, and I'm glad we both like to do active things besides eating. But I definitely don't listen to podcasts on taxes. So I just thought that was really cool.
I am a tax nerd.
I'm glad you're a tax nerd because we want you here and we want to hear what you have to say. So with that, I'm going to hand it off to Angie. Thanks, Angie, for being here. I'm excited to see what you have to share with our audience today.
Thank you so much. Thanks for that introduction, and thank you for all that financial education that you invest so much in. I think that's a great lineup of webinars.
Thank you. Thank you. I am ready for you to share.
All righty, let me just go ahead and share.
All right, I think we reached our cap of 100, so sorry folks if you can't join in.
Uh-oh. I'm sorry. Well, they'll get a recording though, right?
Yes, I will post the recording, so they should have it.
Okay. Do you see my screen?
Yes.
Okay, perfect. Awesome. Fix this. Hello, everybody. I'm so happy you're here. Thank you. Thank you for joining.
Angie, can you increase your volume a little bit?
Absolutely. I'm going to move this up here.
Yeah, your volume is a little muffled, your voice.
Yeah. Is this any better?
Yeah.
Okay, perfect. Thank you, everybody, for joining. I'm so excited you're here. I think we're going to have fun. I know taxes is not a very fun topic for most people, but we'll have fun with it today. I promise you this will be a good use of your hour, and hopefully we will all walk away from here with a few tips that you can actually start putting dollars back in your pocket with just some simple strategies. We're not going to go, I mean, there's hundreds of strategies and thousands of combinations, but we're really not going to go into all of them. I'm going to talk about very few that are simple enough to implement, and you should be able to reap the rewards by implementing them.
Can everyone hear Angie's voice? Just a quick check.
Please chime in if you can't.
I can hear, not great. Okay. Maybe you should turn up your volume. I think, does anyone besides Pranav have any issues? Not very well. Okay. A lot of people having issues. Okay, some can hear. Okay, some can hear you very well, but she's not as loud as me. I'm just a loud mouth.
I am actually not loud, so yeah, that would do it. But I'll try to be loud enough. Hopefully this is better. Please chime in if you can't hear me very well.
Okay.
So my goal today is to basically show you a few ways how you can slash your income tax bill by at least $15,000 in 2020. Again, like I said, my goal here is to.
All right.
I was trying to see why is the sound not okay. So.
If you want to, you can call in on your phone, but I can hear you fine.
Is it for everybody else?
I think it's not super loud and clear, so I think it should be okay.
Okay.
Okay, let's just keep moving. Yeah.
All right. So again, I want you to understand that the Internal Revenue Code actually permits you to take deductions to offset your income. And I want you to understand how you can take advantage of that, just like some big corps do, a lot of big corps do. So we'll dive into that. And I'm saying $15,000, which is federal only, but remember, a lot of states have state income taxes. Some states don't have income taxes, but they still have corporate taxes. So we need to consider that in as well. This is a really good quote by Abraham Lincoln to start dive into this. The best way to predict the future is to create it. This could not be more true when it comes to taxes and tax planning. Working with the tax plan and implementing the plan can really be your best investment in the business. And you'll hear me talk about this a lot during the whole webinar today. But think about it. You may spend valuable dollars in advertising and marketing with the goal of increasing revenue, which is a great strategy. But you cannot know for sure how your results will be. When you're working with the blueprint of a tax plan, which is customized in your particular situation with your goals in mind, and you're implementing it correctly, you're guaranteed the savings pretty much. You really carve out those savings intentionally. And that's what we'll spend our time today talking about. I have to give you this disclaimer. This is not tax or legal advice. This is intellectual property and cannot be distributed. Let's take a little bit of a poll over here. Who thinks here they're paying too much in taxes? And you can chat in or use the little icon to raise your hand or whatever. I can't see that. I can't see the chat box. I'm not that fancy with my 3 screens over here, but I bet you a lot of you are overpaying in taxes. Do you want to know how you can reduce your taxes? And we'll talk about that. But I have some good news and some bad news regarding that, though. I'm pretty sure most of you, if not all of you, are saying you are paying too much in taxes. And really, the bad news is you're not alone. Statistically, small businesses overpay by an average of $15,000 more in taxes annually than they really should be paying. Taxes are probably your single biggest expense. But here's the good news, that you can reduce your taxes by, if you again, you're going to hear me say this again and again, proactive planning is a must. So let's talk about what we're going to do today and how you can walk away with these strategies and how you can improve your cash flow and grow your bottom line, build wealth. In our firm, we've actually helped our clients save anywhere from $8,000 to over $100,000 in taxes every single year. Of course, like I said, we're not going to talk about all the strategies that go into providing those kind of tax savings, but we're going to talk about some of the very basic ones and really that it can be implemented. I'm just going to, you've already mentioned, I don't need to go into my bio, but I bring this over here to tell you, most of the prospects that I talk to, they think that they are getting tax planning when in fact they are not. And I'd bet to say a majority of them, when they're working with tax professionals, they're losing out on money. And why do I say that? Prior to starting my firm, I worked at large and small firms, traditional firms. And, we always thought that we were doing not only compliance and consulting, but also tax planning. We were providing these services to our clients. And honestly, we really believed we did. But you know what the strategies we told our clients when they asked us how they can reduce their taxes were like, buy some equipment at the end of the year, prepay some expenses, fund your retirement account. Those are the basic strategies that traditional CPAs, as traditional, and I was there, so I know that exactly. I was in those shoes. That those are the strategies that we recommend to our clients, but that is not proactive tax planning. That's proactive tax planning is basically using the Internal Revenue Code and structuring your operation so that you can make expenses that you would normally pay after tax, you're getting the benefit of. You're putting them above the bottom line and making a deduction out of that. That's really where the savings is. So when I was working at these firms, I got asked a lot but from my clients how they can reduce their taxes. And when we were coming up with these, in fact, a few times, even the principals, the partners of the firms would say, oh, you made more money, so it's kind of logical that you will pay more taxes. That didn't sound right to me. I mean, we all know Warren Buffett, his marginal tax rate is at 15%, much lower than his secretary. Does anybody know how much tax Amazon paid on $13 billion of income in 2018?
Was it zero or single digit, something like that?
What, you're right, it was zero, but they in fact got $130 million back in refunds. And why, you ask, is because they have the resources, they have the tax departments who are working diligently to find strategies for them to be able to save on taxes, right? So I say this because Internal Revenue Code is the same for all businesses, for all taxpayers. It's how you utilize the Internal Revenue Code to your advantage. And it's really is a classic case of you don't know what you don't know. So as small business owners, we think, my clients will tell me, my tax planner is taking care of, my tax preparer is taking care of planning. And in fact, we all know that's not true. I know that's not true because I was that, right? And we were not doing planning the way planning should be done. So we will just dive into that today. That was my big spiel. That's what I'm so passionate about, bringing this awareness that take charge of your finances, take charge of your business, of your hard-earned money, and don't just donate it to the IRS. Work with the strategist, work with the planner who will help you divert that money that you're paying to the IRS back into your pockets.
And I want to say something here, Angie, because as a 9-to-5 employee, I believed for the longest time that I had no way out of paying taxes, that only companies like Amazon and people who had access to all these strategies could actually benefit from it, until I found real estate and realized depreciation and all these other cool things. I didn't know that was possible. And last year, for the first time, I paid zero. So
right.
like,
you found that tax loophole that works for you, and it's there. You just have to know how it works and how to implement it and take advantage of it.
Right, and it's legal, right? There's nothing illegal about this.
Yeah. Absolutely, it's all legal. Even William Rehnquist, he said there's nothing wrong with the strategy to avoid the payment of taxes. The Internal Revenue Code doesn't prevent that. In fact, Internal Revenue Code has 88,000 plus pages, and most of them relate to tax deductions. So it's right there. You just need to work with somebody who is working, who's on top of this in order to take advantage of it. So now let's talk about, get into this and talk about what are the different categories, if you may say, that you can utilize the tax planning. Every time you spend after-tax dollars that could have been pre-tax dollars, you lose. Let me repeat that. You lose every time you spend after-tax dollars that could have been pre-tax dollars. And that really is the goal of tax planning, how to reposition those after-tax dollars and get the tax advantage of it. So there's 4 main buckets of strategies that you can use. First one being timing. Timing, I'm sure everybody is aware of. It's like, deferring tactics, which is like 401k. You defer today's income into a year, so you don't pay income tax on it now, but you will definitely pay income tax when you take that money out. Then there's income shifting strategies, which basically move taxable income to a lower tax bracket, kind of like how you would if you were to shift income to your children. I will talk more about that. Code-based strategies, what Kavita you talked about, real estate professional, that will be one of them. Section 105B, that's another, and we will go more into detail on that one today. And then there's product-based strategies, like I mentioned, funding a retirement plan, which gives you a benefit. We will focus on the first three strategies today, but I just want you to know that product-based strategies can also be very powerful in your overall plan. So the first one that we're going to talk about is entity selection. This is so important. I don't care whether it's you're starting a side gig or you're investing in some real estate, or you have a business, whether it's services, product-based, whatever it is. This is the number one opportunity I see that taxpayers can avail of, and also the number one biggest mistake I see business owners make because they choose the wrong entity. Most business owners start as sole proprietors, which is fine. And then as they grow, they establish an LLC or a corporation to help protect them from business liability. And generally, I hear professionals say, advisors say, when you're an S corp and you're sole proprietor, when you're a sole proprietor Schedule C, you should be an S corp right away. And that's the wrong answer, and we'll talk more about that. But being in the optimal entity for your particular needs, tax-wise, legal liability-wise, very, very important, very important. Choosing the right business entity actually involves all sorts of tax considerations as well as legal that I said. And it could be that when you first chose your entity, that was the right entity at that time, but most business owners don't consider reviewing it ever after that. And that could be an issue too, especially we see that with the 2017 Tax Act, TCJA, how it just, made C Corp so much more efficient than the past two entities and what have you. Again, it all has to be customized to your particular situation. I'm not going to be able to make you an expert in all the business entities today, but I'm going to help you diagnose some common problems that might be costing you taxes when you don't have to pay them. So let's dive deeper into some of these entities. Basically, you got to know when you're either a sole prop or S corp, partnership, C corp, right? Those are the different entities that you could be operating as. Now, what is a sole prop? Like I talked about, when you're starting a side gig, you probably, it's just on the side, you're making a little bit of money, you might want to just start operating as a sole proprietor. And let's start with one problem I see a lot of business owners make over here. They pay too much in employment tax, and that's why most advisors will say, oh, Schedule C is not optimal for you. You should be an S corp. Most business owners start out as sole prop, and then it's, you got to understand that when you start out as sole prop, you don't necessarily want to be an S corp the next day. You want to have enough income in your business before you decide to be before you decide to incorporate. But in this case, let's say the sole prop, you start a sole prop, you report income on your Schedule C, you pay income tax on your net income, which is your at your income tax rate. But then what you're also doing is you're paying self-employment taxes of 15.3% because you really are the employee and the employer of your business. And that can add up. For 2020, this is 15.3% on the first $137,000 approximately. plus 2.9% of Medicare tax. And plus add to that, if your income is over $200,000 for individual filers or $250,000 for joint filers, then you have another potential of 0.9%. So it all adds up. All of these taxes add up when you are operating as a sole proprietor. Now, I know you could be saying, is this really a problem? Because after all, self-employment tax is what you pay in lieu of Social Security tax. And that money goes into a Social Security trust fund where really bankers are carefully investing it for your future retirement. Really? Is that true? I mean, I don't know how many of you believe and rely on Social Security. It really doesn't work that way. Taxes go in, benefits come right out. Any excess gets invested in treasury bonds, which means Uncle Sam pretty much starts spending it right away. And let's not get into the politics of it, but I want you to understand that most business owners do not rely on Social Security for their retirement income. And I don't know if you can afford to either. So there needs to be an alternative. The alternative, like I said, could be an S corp. I'm not saying it should be or is. It could be an S corp. Establishing an S corp solves that problem of the self-employment taxes by dividing your net income into two parts. Basically, you have a salary and then you have a return on investment. And your salary is subject to payroll taxes, employment taxes, but the income is really a return on your investment to have this business. So here's how it works. The corporation will pay you a salary for the service you perform as an employee, and you will get a W-2 for that amount, just like any other employee. And the rest will pass through to your personal tax return as dividend, basically. In an S corp, you're able to take the excess as distribution. So you'll pay regular income tax on both the halves, the salary and the dividend, just like you did with your sole proprietorship income. You'll pay employment tax in the form of FICA withholding on the amount you take out as salary. It's the same 15.3% up to that threshold of 137,000. Plus, all 0.9%, all of that. But here's what the magic happens. You'll avoid employment tax entirely on the amount that passes through to you as dividend. You don't pay any taxes on it. That's the beauty of the S corp. Now, that certainly looks better than the taxes you would have paid as a sole proprietor. And like I said, and that's the reason a lot of practitioners will just say, oh, you should be a S corp. Again, it needs to be identified on and customized based on your needs. And like I said, C Corp could be a very, very valid entity for you to be in. Again, it needs to be assessed. We'll leave that out of the topic today because I need to get through some of the other strategies. But I do want to point out in an S Corp, and I see this mistake so many times, you as a shareholder employee, you have to take out reasonable compensation. You might say, oh, if my compensation from the S Corp is really only part of it that I take as a salary is subject to self-employment taxes and the other is not, why should I even take salary? But that's where you can't do that. That's a huge audit alert. The rules, IRS rules, require you to pay yourself a reasonable salary for the work you do as an employee. And it's reasonable. It's not saying you have to have 500,000 or 5,000, right? It has to be reasonable for the work you're doing. And that's not always easy to determine. We actually have a tool that calculates what your reasonable salary should be based on several factors. And it has actually held up in a lot of the IRS audits. If there is, I want you to understand, if on an S corporation tax return 1120S, if there is no officer compensation, that's like calling out to the IRS, come audit me. You don't want to do that. So now, as you see, there are several options for entity. Again, the takeaway from this is, yes, S Corp, C Corp, partnership, sole proprietor, they're all valid entities, structures. You have to analyze it based on your operations, your goals, your exit. How all of those have to play into what entity is optimal for you. That's number one. I don't know if you have any questions in the chat box, Kavita, or should I just?
We do, but we can get to them later. I think it just, we can answer all the questions and answers. I mean, do
Yeah,
it.
sure, sure. The next one over here, again, can be really easily implemented in your businesses, and it can bring great tax savings with the use of an accountable plan. I'm just going to take a sip of water. So let's talk about this. If you are an employee and an owner of an S Corp or a C Corp, and you have unreimbursed business expenses, you can actually use an accountable plan and get your business expenses reimbursed by your business. Now, a sole prop cannot, and a partnership cannot, because in a sole proprietorship and partnership, you're really not an employee of the business. This is a huge benefit, but the IRS is very specific with the guidance, so you have to make sure that you follow the rules and you document it correctly. If you qualify as a corporation, or maybe you can carve out a corporation out of your business operation. Analyze it if it's worth using this, based on your cost benefit analysis, and reimburse your out-of-pocket expenses. Remember, I have seen several tax returns where business owners will try to or deduct these expenses, these personal expenses, out of their business P&Ls and think it's okay. But remember, if you were to get audited, all of these would be included as payroll, and that is really not a good place to be. And if you don't implement the accountable plan, like I said, what the IRS in an audit will do is they will reclassify it as compensation, pack on payroll taxes, penalties, and interest on it, and you end up being, with a big tax bill. So documentation is critical in this. So what you want to do, you want to do an accountable plan to execute it, and you want to publish this document in your records or whatever that declares that you have an accountable plan. Now the IRS does not generally require you to have a document, but we always recommend that you do, because it's all about documentation in a case when you're challenged. And then you'll be allowed to reimburse your employees. And remember, you are an employee yourself too, tax-free for the expenses submitted in the accountable plan report. Now, and that's your call as a business owner, what you need to be listed as reimbursable expenses. Again, like I said, you want to make sure you're taking advantage of this, but you're also doing it right. Implementing it correctly is really important. And remember, with TCJA, a lot of the unreimbursed expenses, you were able, before TCJA, you were able to deduct it on your Schedule A. Now that's all gone. So this is a great way to get a deduction for all of those unreimbursed business expenses. Steps for setup and compliance. Like I said, there is no IRS form to use, but again, we have a template that we give out to our clients, and if anybody wants to send me an email, and you basically reimburse the employee expenses per the plan. always have a cash trail to demonstrate that you are implementing the accountable plan per IRS regulations. There's a template you basically, and you would use this for, whether it's your home expenses, your utilities, or, really as a business owner, you can set in the accountable plan what you want reimbursed. Of course, it's got to be reasonable. And email us if you'd like a copy of the template, and we'd be happy to send that over to you. Okay, I'm talking a lot. My throat, sorry. I'm curious to see what the questions and comments are, but we'll take it when we get to the end. Non-deductible expenses. Let's talk about healthcare costs. Surveys have shown that healthcare costs are neck to neck with taxes when it comes to business owners' biggest concerns and costs. If you pay for your own health insurance, you can deduct it as an adjustment on page 1, as an itemized, you can deduct it on page 1 as well as itemized deductions depending on what it is. If you itemize, you deduct it under subject to 10% AGI. But of course, it has to total more than 10% of your AGI for you to get any benefit out of it. And most of us don't spend that much on our healthcare. So we basically just lose out on those deductions. But if there was a way to write off these medical bills as business expenses, so you don't lose them because of that 10% floor, wouldn't you be interested? I mean, that's a great way to get a deduction for some of the medical costs, which basically, like I said, get really unused on your Schedule A, which is your itemized deduction schedule. There's a couple of ways you can do that. The first one is called the medical expense reimbursement plan. This can be super powerful. Now, let's take a look at this. What this entails is, again, just an accountable plan. It's a policy that you as a business owner have to maintain within your business. With the huge sweep in tax reform, like I mentioned, Schedule A, even if you're filing a Schedule A, I think a lot of people, well, Californians and New York, there's definitely they're still filing Schedule A, but a lot of states don't have state taxes or even not high enough. And if you don't own a home, you probably are not even itemizing. So this is so you basically lose out on that. So this is a great way to get benefit of that without being dependent on Schedule A itemized deductions. You can take personal deduction to convert it into business. Again, that's where the whole theme is. Our role is always to look for these opportunities. Implementing the MERP, as it's called, Medical Expense Reimbursement Plan, prevents the out-of-pocket medical expenses being limited. Now, this has been around since the 1950s, I believe. There's one caveat: S corporations cannot use, who have more, for a shareholder who's more than 2% shareholder cannot use this. But there's ways around it, and we're not going to go into that today. But there are certain entities, sole proprietors can definitely use it. C corps can use it as is. S corps have a little bit of twist, but there's a workaround for that. Generally, the way it works is taxpayer reimburses a spouse working for the business for eligible expenses if you're a sole proprietor, and the business pays wages to the spouse because the spouse is not working for them, and now the self-help insurance premiums get deducted along with any out-of-pocket expenses. It could be for kids' braces. It could be, I'm sure you can think of multiple of the medical business expenses that the medical expenses that you could get reimbursed for, and make them tax deductible. That's the bottom line. Now, what this does, we talked about the self-employment taxes in case of sole proprietorship, right? So this lets you not only take a deduction for your from the business, lowering your taxable income, but it also reduces self-employment taxes, so which is a great deal. Now, health insurance premiums, if you were to deduct it on your 1040 or your personal income tax, they don't reduce your self-employment taxes. So this really benefits you on both ends. Now, I mentioned in order, if you're a sole prop, you have to kind of turn around and hire your spouse and then get them a reimbursement. In a C corporation, you don't even have to use your spouse because you really are the employee, and you can offer the work to yourself as a business owner directly. This can be really, really powerful. And there are steps to implement. Basically, you need to get an estimate of these costs and the cost of other employees if you have them. Do the analysis. If your business is a single shareholder with no employees, you don't even have to worry about non-discrimination rules. Then it's just you yourself. The good news is the cost does not have to be big every single year. It's like maybe 1 year, if you were having a kid, this could be $15,000 out of your pocket. And the other year, it could be just $10,000, and that's okay. It actually costs very minimal to set this up as well. You can generally get it done for under $200-300. And the benefits are huge in this for sure. I strongly recommend you looking into this if you haven't already. How are we doing on time, Kavita?
We are good, 8:21. So I'm hoping to wrap up by 9. So we're good.
Okay. So the next one I'm going to talk about, again, it can be super powerful in so many different ways. Hiring your children. This can save you thousands of dollars in taxes. And, you know, it could be your children, it could be grandchildren. It could be a great way to cut taxes on your income and shift income to their level. Yes, there is a minimum age, and we will talk about that. That's 7 years by IRS audit cases. So remember, what happens in this case is the first $12,400 of earned income is taxed at 0. And that's because the standard deduction for a single taxpayer is 0. And the next approximately $9,000 is taxed at just 10%. So you can shift a whole lot of income downstream, get benefit on your tax level, shift income to them, have them pay for costs that you would normally be paying them out of your after-tax money. You know, this could be so phenomenal, and it could get them started on creating a nice chunk of money for themselves. Now, you have to pay them reasonable wage for the service they perform. And by reasonable wage, there's a tax code that stated that it would be what you would pay a commercial vendor for the same service. Of course, you would adjust it for the child's age and experience. So if your 12-year-old daughter cuts grass for your rental properties, pay him what a landscaping service might charge. If your 15-year-old helps you keep your books in place, pay him a bit less than a bookkeeping service might charge. Does anyone have any teenager who helps them? I mean, if you have rental properties, they could do work around the rental properties. If you have a business, they could, help you with your website, social media. Definitely, my kids are way more advanced in social media stuff than I am. There's so many different things that could be done. And always, always, always audit proof your return. Like I always say, documentation is critical. You want to write down a job description and keep a timesheet. I sometimes even suggest take pictures of your kids working, taking trash out, scanning, shredding, whatever it is that they're doing. I know I have clients who their 8, 9-year-olds are helping them with social media. Pay them for that. Pay by check so you can document the payment, open a separate bank account for them, follow the guidelines, and you really can save thousands of dollars in taxes and teach your children the value of money at the same time. Do you know, if your kids started investing today only $10,000 out of their paycheck, over 30 years, if you just let it grow at 5% rate of return, that could grow to over $800,000 over 30 years. I mean, that's phenomenal. And then just think, what if they contributed that to a Roth that they could take out tax-free? That's amazing. Why would we not want to do that and get tax benefits out of it while teaching the kids these good habits? I am going to move over to, there's some stuff over here, we talked about this. Work must be actual and done and related to your business, must be reasonable, child should be capable, be reasonable with it, and keep documentation. Now this one is really this is really a gem of a strategy. It's a hidden strategy actually that most advisors are also not aware of. And the reason is because it's not used as much. When President Trump issued the emergency declaration related to COVID-19 pandemic, this is when this code section gets triggered. The IRS used the emergency declaration to delay tax season until July 15th. And it's the same federally declared disaster that triggers the that triggers this code section 139. What code section 139 allows you to do only in times of federally declared disaster. So we are in a federally declared disaster now. So this is until we, I think, March, whatever it started, until the end of it. This is the time that we can use this code section to take advantage of it. What this does, it allows an employer to make tax-free payments to reimburse or pay the employees for expenses that would otherwise not be compensated for. It could be, sorry, you heard that. It could be, medical costs if, say, if you were subjected to COVID-19, anything reasonable and necessary personal, like family or living or funeral expenses that were incurred as a result of this disaster. What you can do is reimburse the employee. Now remember, I'm saying employee, but it doesn't have to be another employee other than yourself, as you are the employee of your business. So this really applies to you as well as other employees if you have other employees in place. They have to be reasonable and necessary expenses, but it could be, a lot of people are now, everybody is now working from home. So additional expenses that you had to incur to set up a home office, to maybe you had to get some repair or rehabilitation done in order to facilitate you to work from home. Now these get all fully deducted by the employer. and they're not taxable to the employee. Generally, if you were to provide these would be taxable compensation to employees. But utilizing this code section allows you to for it to be tax-free to employees. And those are not all. I mean, look at these tutoring expenses for employees' children. How many people over here on the call have little children who are probably not be able to go to daycare, or you have to homeschool? Expenses. You know, I have a client that had 3 kids, and they couldn't go to a daycare, so they had to have in-house nanny take care of it. Generally, that's not a business deductible expense. This code section gives you the ability to do it. Again, everything reasonable, and documentation. Telecommunicating costs, such as computers, printers, whatever have you. So this can be really, really advantageous. Again, the statute doesn't require any formal written plan. Of course, we suggest that. Again, documentation is utmost important, and we have a template that we share with our clients, and then they can modify it however they like, or whatever the policy they kind of keep in place. Let's see what else. Again, like I said, if you don't have employees, so be it. You're the employee, that you actually have more control, because you're not subjected to, and this one, you're not subjected to non-discrimination rules at all. So you can, maybe you have an employee who's been seriously impacted and you want to compensate them, you can do that. But just make sure that there's documentation. Now, like I said, Section 139 has never been utilized in response to a national pandemic because we didn't have one, right? And so there's limited guidance on this. But if you comply with the spirit of the provision, be reasonable, reimburse employees for costs pursuant to your document that you have adopted, and really the payments should be fully deductible to the employer and tax-free to employees. So use it. All of these, if you were to implement all of these strategies, you could probably save a lot more than $15,000. $15,000 is just like an average that I'm thinking, because, you know, again, there's hundreds of strategies, thousands of combinations. Not all of them will be applicable in your situation. Some of them might be. Some of them will be variations. So just take the knowledge from here. So just to recap, we talked about what is proactive tax planning and how it is very, very important and very different from tax preparation. I think that's probably the number one thing I want you to take away from today's webinar is proactive tax planning is very different from tax preparation. Do not confuse the two. Do not confuse that you are getting planning with your tax preparation. I have seen clients lose out on thousands of dollars because of this. We're actually working with the client right now, and with his tax plan, we're saving him $154,000 in taxes going forward. The sad part of that's exciting, but the sad part of that is that means he was losing $154,000 all these years. That's money that really, I know I can do a lot better with that money than just pay to the IRS. And I'm sure you guys all think so too. Like I said, you just cannot afford to not plan proactively for your future. We talked about these strategies. I'd love to hear your comments, your questions. Oh, and I have a ebook that talks about 7. You know, we talked about a few today. I think it talks about a few others in that book. If anybody would like to take advantage of that, please go ahead and go to that URL, go.fintaxcpas.com, and download your free copy if you'd like. Go to our LinkedIn page. Join us. We're always sending out tax alerts and news on LinkedIn, Facebook, Instagram, and if you'd like, I think Kavita, you will share the listing, and then we can, if it's okay, we'll add folks to our newsletter mailer, and we're always sending out. We're on top of technology. We're on top of tax law changes. I know in March, April, we just started doing so many webinars and started hosting town hall meetings because there was so much confusion with PPP, EIDL, all of that. It was just keeping us on our toes. And I was like, how are business owners who are just struggling with so many other things are going to be able to keep up with all of these ever-changing tax codes? So we're doing webinars and seminars and educating. I think that's how we really connected so well, Kavita. I love the fact that you're so driven by that. That's my passion as well. These testimonials are, clients who just were looking for solutions, and when they got tired of overpaying taxes, and now how thrilled they are that we're able to save them money. They don't have the headache. They save them money, and they're building their nest egg. So that's our competitive advantage. Like I said, we're on top of technology. We really are a revolutionary firm in a lot of ways. That's about it for my presentation today. I'd love to hear questions.
Yes. Lots of questions. Thank you, Angie. That was very informative. I know I got away a lot of takeaways here with the medical reimbursement, disaster relief. And I know there are probably a fair number of W-2 employees here wondering, how the hell am I going to take advantage? I have news flash for you guys. You guys need to set up a business. You need a side gig. You need a hustle, right? That's how you take advantage.
Well, and sadly, that's true. The tax code, I mean, we all see what happened with the CARES Act, right? All these incentives being given out for business owners. Small business is really the backbone of the economy. And that's where the tax code really has all these advantages. Yes, buy real estate, start a business, and then take advantage of. Having said that, if we work with a lot of high net worth, high income wage earners, and there's I want to say there's more strategies that can be implemented for them to reduce their taxes than an average income earner. So a high income earner still has some advantages that the IRS code provides them. But yeah, most of them are for business owners.
Right. And business owners, as business owners, you contribute to the economy, and the IRS allows you to take taxes off, right? It's sort of like a give or give and take. So questions. All right. Lots of questions here. We'll start with Mark. I recently tried to change my W-4 withholdings and was surprised on the drastic changes. There is no longer a way to choose specific allowances. Can you offer some words of advice in filing the new 2020 W-4 form? I am tired of paying estimated taxes every quarter.
Great question. So really your HR should be able to help you with that. Or what you can also do is when your tax preparer gives you those estimates that you need to pay on a quarterly basis, just add, most companies HR will just add a dollar amount to your withholding. That should be pretty easy to do.
I hope that
answers. And first of all, why is it that, if you're only W-2, why is it that you are paying, you are having to pay estimated tax payments, right?
Oh, I think he said W-4 form, not W-2.
Right. But W form is for withholdings on W-2.
Okay. Sorry. Okay. As a passive investor, if I have a negative K1, will it reduce my taxes, or do I need to be a real estate professional?
Great question, and this goes a lot into tax law. So you as an investor, you are able to take losses only up to what your basis is. So it gets more technical, it gets more complicated, but know that if you have losses that you're not able to take because of your AGI is over the threshold of $150,000, and you're not able to deduct it against your other income. Now, is this coming from your Schedule E, or is it coming from a partnership that you're investing in? So again, short answer is your losses are limited to your basis. So I'll probably have to look into what your situation is.
So it will reduce the taxes from a distribution standpoint, right? Let's say they have a negative K1 and they're getting distributions from this property. They are able to offset those distributions without paying taxes, right?
So distributions, you're talking about distributions coming from a partnership?
From the property or the investment.
So if it's a Schedule E, so it's a rental property that's on your Schedule E, there's two different things. Cash flow that's coming to you is not taxable. That even whether it's cash flow from Schedule E, or if it's a partnership and you're getting distribution for partnerships, or if it's an S corp and you're getting distributions, those are not taxable. Income allocation and distributions are two different things. The way income is allocated to you, yes, income would be taxable, and if your income is a loss, then the loss will be limited to your basis in that partnership before you can actually deduct it on your tax return. So to answer that question, yes, being a real estate professional, if you qualify to be a real estate professional, is a really good place to be, because real estate professional, that status gives you a lot of tax benefits.
Right.
But there's strict rules for eligibility.
And if a spouse qualifies, you can still use the deduction, right?
So that's a great point.
So maybe one of you can qualify. So Kunal asks, for S Corp, does reasonable salary clause apply if you have another high-paying W-2 job?
If you have another high-paying W-2 job, but you're still spending time in the S corporation, depending on how much time you're spending in the corporation, what you're doing, and that's why I said it gets complicated. How much is the reasonable compensation? And the tool that we use actually goes through all of these questions. What are you doing in the S corporation, right? Are you doing day-to-day activities, or are you just supervising, or are you doing marketing, whatever have you? It goes through those questionnaires, and because that's all a part of the answer. When say you have an S corporation and you're generating $200,000 of income in it, and you have let's say you have $5,000 of owner compensation. At the first sight of it, that may be too little of a compensation, but can you justify it? And that's where this tool comes in really handy, because it goes through the whole process. It kind of takes you through these questions, and it spits out, okay, this is based on what you're telling me, this is what your reasonable compensation is. And that you can, there's no qualms with taking that, because IRS blesses that actually. Long answer to your question, but it really depends. That seems like the accountant's typical answer. It depends, because it really does depend.
So another related question, does reasonable compensation vary by location?
It could. It could. It varies by the jobs and activities. It varies by a number of things. And it could, say if, I'm just throwing it out there, say if you're an engineer and in California, you may be getting a certain, an engineer who's doing, another engineer who's doing the similar job as you may be getting a certain rate or salary, and in another state it may not be. So it could be dependent on that.
Okay, question on the accountable plan flow chart. Looking at the yellow box on the extreme right-hand side, if you reimburse employees for, say, travel and mileage. Does that have to be reported on employees' W-2 box 1 wages?
That is the beauty of accountable plan, right? So what you're doing is you're reimbursing the employee for those expenses using the accountable plan, so it's not wages to them.
Okay, it's just a deduction for you, but not wages for them. Okay, what is the minimum age requirement to have kids on payroll? I think you said 7, Angie. I have a question there too, because I've seen some folks who have their kids as models on their website and in their presentations who are like young kids under 7. How does that work?
And that's definitely doable. I'm just stating from an IRS perspective, because up to 7 years in audit cases, they have cleared it. It's very likely, yeah. I mean, if you can, if you're using your child's picture as on your website, right? Fine to pay them. I just wouldn't pay them $50,000 or, unreasonable amount. Something which would be reasonable and you can justify.
And do they have to pay them as an employee, or do you pay them as an independent contractor, or does it matter?
You could. I've seen it both ways. You could pay either way now, and I know it should not matter, but some banks, because the next step to that is I'd like them to contribute to a Roth IRA, start a Roth IRA for them. And some banks actually have an issue with that. So it really doesn't matter as long as you. And one thing I meant to point out is when you're hiring your children and you're hiring them under a Schedule C or a sole proprietor, you don't even have to pay FICA taxes. So which is another additional benefit. However, that's not true if you're hiring them under an S Corp or a C Corp. It's only the Schedule C sole proprietor and a partnership in which both parents are partners.
Okay. A couple of more questions here. Can I use the qualified reimbursement, medical reimbursement plan for myself in addition to my employees?
What kind of entity are you? It would depend on that. Yes, and you can, if you are a C Corp shareholder employee, yes, you can. If you are a sole proprietor, you cannot, but you can hire your spouse and then reimburse through her.
Got it. All right. What medical costs can be included in the medical reimbursement plans? Just health insurance deductions, co-pays, the what you pay for the health insurance every month. For married couples who need to buy health insurance, which entity, C Corp or S Corp, will fit better?
Okay, those are two different questions.
Yeah. The first question is, what medical costs can be included in the MRP?
Really anything out-of-pocket medical costs, and that's the beauty of it, because generally when there's ways to deduct your health insurance if you are if you are a business owner, you're a sole proprietor, you can adjust it above the line. You don't get full benefit for it, but you get some benefit. If you're an S Corp shareholder, you again, it's treated the same way provided it's done correctly, and I've seen that's another issue I've seen so many times, not being reported correctly on W-2, so the employees, the taxpayers is not able to take a deduction for it. But if you're a sole proprietor filing as a Schedule C or a C Corp shareholder, you can pretty much deduct out of your income insurance premiums, co-pays, eyeglasses, what else? Braces, dentists, everything. Well, when I say everything, there's a whole list. So not just the health insurance premiums. And there was a second part to the question.
Right. For married couples who need to buy health insurance, which entity is a C Corp or S Corp is better?
That really is, I wouldn't really, that I don't think that even matters.
Okay. If I have taxes, a lot of questions, so I'm going to move ahead. If I have taxes for 2019 and plan to file my tax and pay the amount due by September 15th, will my interest and penalty be calculated from July or April 15th? Because this year, everything was July, right? The
So
estimated.
generally, it would be April 15th. And I think you're talking about a 1040 because you said April, but you said September, so that makes me think it may be an entity. But generally, I'll just give a general answer. The penalties start from the filing date. So if you're an entity, it would be March 15th. If you're a partnership or an S Corp, it would be March 15th. If you're a C Corp or personal tax return, it would be from April 15th. However, in this year, this was a weird year. The tax season never ended this year. It would be from July 15th.
Can you show your LLC entity selection, please, once more? How about, if you want to go back to it, how about the cash benefit pension plan save pre-tax? I don't know what he's talking about. Maybe you do.
So what did you want to see in the entity selection?
Slide, cash benefit pension plan save pre-tax. I'm not sure of the question.
Cash benefit pension plans can definitely save on taxes, and it would help with on a S Corp, C Corp. It would help reduce your taxable income. Definitely.
Disaster relief payments, can this be executed for S Corp owner? And if yes, does this have to be extended to all employees in the corporation?
Yes, to the first question, it can be extended to S Corp shareholder. And beauty with this, well, I shouldn't say beauty, but the good part with this is it's not subject to non-discrimination. When I say non-discrimination rules, what it means is, say if, like MERP is subject to non-discrimination rules, meaning if you have a policy to implement a MERP, you have to make it available to all employees. However, there are ways you can, we work with really qualified administrators. There's ways that you can kind of not make some employees participate in it based on age and the length of the time that they have been with you and all that. But it is subject to, so if whatever the criteria is, and if the employee fits into that criteria, it has to be available to them. For Section 139, it is not subject to non-discrimination rules. So if you have an employee that you really value the work, or they went through serious times, or they had a death in the family, or whatever, for whatever reason, you can pay these payments to them only and not to some others. So that's what the meaning of non-discrimination.
So Suchi asks, can we contribute to 401k for an 18 and a 14-year-old? I believe the legal age is 21. So is it possible to contribute towards their 401k in my S Corp?
Okay, there were two questions.
No, it's just one question about contributing for under 21 to a 401k.
It all depends on the plan. It depends on the company plan. So I would suggest work with an administrator. You have to work with an administrator, and it depends on the plan that you put in place. So you could put, if it was your child that you wanted who's under 21, but they were working for you and they were eligible for the 401k, you could work with the administrator on that.
Hi, I don't own any business. Rather, I'm a salaried IT professional. Are there any legal ways to save money? My favorite question.
Great question. Great question. And like I mentioned before, most of the Internal Revenue Code is driven towards savings or deductions for business owners. However, depending on salary, I mean, I have clients um, who are higher wage earners, and we're able to help them with taxes. So I would say by high wage earners, I would say at least $500,000 or over a year, or sometimes depending. Again, depends, right? It could be. Um, I'd say it's worth looking into, but for an average wage earner, it's kind of hard to find ways to reduce their taxes
You
unless you
can't
have
just set up
side
a
gig.
side gig.
Side gig.
I like.
Side is a must.
I understand the paper loss due to depreciation on K1 for real estate investments can offset other passive income. What counts as passive income for this purpose? Can it offset short-term and long-term capital gains you wish incurred by selling stocks?
No, I'm sorry, no. So passive, you have to think about it just as the name says, you're passive in that. You're not actively participating in that activity. So if you have by definition, as a standard rule, rental real estate is a passive activity. However, you make that an active activity by being a real estate professional, which is you're spending at least 750 hours in a year in real estate, other than your own real estate. There's lots of there's 7 rules that you have to fulfill on that. And working in real estate doesn't mean that you're working as a W-2 wage earner in a real estate. So and then there's another set of ruling for material participation. So there's a rules that you have to comply with, and if you're eligible, you get to be an active um, participant in real estate, and that's when the benefits you start getting the benefits of the tax.
Yeah, we actually did a webinar on how to qualify as a real estate professional for tax purposes. The recording is on YouTube. So if you want to go in and dive deep, that's the webinar recording you want to look for. My CPA did that one, so that is a good one for you to watch. Do all the strategies you cover apply for LLCs as well, or just S Corps and C Corps?
So I'm thinking when you say LLC, you mean LLC taxed as a sole prop? Because I get this a lot. So let's clarify this. LLC is not a tax entity. LLC can be taxed as a sole proprietor. It can be taxed as a partnership. It can be taxed as a S Corp, C Corp, whatever have you. So when you say LLC, since you mentioned C Corp, S Corp, I'm going to assume you meant LLC tax as a sole proprietor. All of these, I think I mentioned in that all of the accountable plan does not work. Mark works way around if you employ your spouse. S Corp is a little tricky, but we can work it around. C Corp is not a problem at all. So I hope that answers your question.
Okay. There was that one. There was a contribution for 18-year-old. That one we answered. What is the way for S Corp to save or reimburse medical expense? Is that what you, for S Corp to save or reimburse medical expense?
I didn't understand that. S Corps, you would pay your health insurance. I think that's what we're talking about. Your health insurance premiums that you pay for a 2% shareholder or more, 2% or more shareholder. The S Corp can get a deduction for it, but it's very important that when the W-2 is prepared, that health insurance premiums is put in box, I don't know what box it is, box 12 or 14 or whatever that is. is put in there, and it's included in wages, because what happens on the 1040 then is that gets included. The health insurance premiums are included in box 8 of as wages, and then you get above the line deduction for health insurance premiums. So it's kind of a wash on the 1040, but the S corp gets a deduction for it.
Okay.
And if you don't do it that way, IRS will disallow that. So that's why I say it's very important to have the W-2 prepared correctly.
Do you just help with tax planning, or do you create entities?
So what we do at our firm, and we have a group of, we're like a family office firm. So we have CPAs, financial advisors, and we work with other attorneys. So what we do is we look at entity selection from the tax perspective, and we do not do the legal formation, because that's practicing law. So our attorneys work on that documentation for them.
So someone says, where would I get that beer mug? I just thought it was funny.
What?
Your beer mug, your water mug, beer mug.
Okay, I'm a teetotaler, but this is, my husband went to Oktoberfest by the Bay. And this is where that's from.
There you go, you got it.
Water, no beer.
All right. If I am a business, my wife and I have $350K in W-2 income, and we have a real estate business that makes $30K, but I spend 700 hours a year on my real estate business. Can I be classified as a real estate investor and offset my W-2 income with K-1s for my passive investments?
So yeah, you would be a real estate investor, but I would think it would be really hard for you to be eligible to be a real estate professional if that's what you're asking. Because if you already have a W-2 job that you're spending 2,000 hours, how are you going to justify to the IRS? Maybe you can, I don't know how, but if you can, and the documentation is there.
Yeah, I've heard different things about it. My CPA thinks we need to spend 1 hour more in real estate than you did in your W-2 job, which makes it really hard if you're working 2,000 hours in a W-2 job to spend 2,001 hour in real estate. So everybody has a different take on it, but the bottom line, it's very hard. But if you're working part-time, it's totally possible, right?
If you're working part-time, you can justify it, right? If you're working full-time in a job, how do you justify that you
have enough hours?
Yeah.
Yeah. Can my business report a loss every year?
Well, if you are a Schedule C sole proprietor, and if you show losses for more than 2 years, going on 3-4 years, IRS is definitely going to take a look at it, and they're going to reclassify it as hobby losses, and they're going to disallow the deductions. Now, if you legitimately, if you're incorporated, and you're starting your business, you have legitimate, and remember, it's not about showing something, you have to show what it is, right? And that's why I love that saying by William Rehnquist, tax whatever he says, tax avoidance is okay, I gotta go back. I love that saying. Avoiding to pay taxes is not a problem, but kind of evading taxes, that was the word I was looking for, is a problem. And obviously nobody wants to do that, and you're not wanting to do that. But if you legitimately have losses, and just think of it from the IRS perspective. Sure, if there is a Schedule C and you have 4th year of losses, that's going to come back. They're going to come back. But now, if you have a C corp or an S corp, and you really are trying to ramp up, you're investing in the business, and you have deductions, and you are really a loss, then you are at a loss. So nothing wrong with that. I don't think S corp and C corp, and coincidentally, Schedule C sole proprietors are the ones that are audited the most. They have a higher rate of audits.
Nehal asks, any smart ideas to save taxes on rental income in Texas? I'm like, why are you paying taxes on rental income in Texas? We don't we pay so much in property taxes, there's no rental income. And we have, I hope you're taking advantage of depreciations, Nehal, on your properties. Any other ideas, Angie? I don't even know how you make an income in Texas. I would like to know how he makes income because I need to learn.
Well, I'd need to look at what you are taking advantage of to know what you're not taking advantage of.
That was a quick one. I'm on W-2. How can I pay my kid who helps me?
Again,
Help you with what? I think I
get a
can.
side gig.
Like, what does he help you with? Like lawn care?
It has to be for a business purpose, right? So if you don't have a business, how is your kid helping you with a business? So you need to get a side gig. Theme of the webinar today.
You need a side gig.
Mine, huh? Wow.
All right. If kids, I have this question too that Kunal has. If children, I've actually paid my daughter on a 1099 miscellaneous last year, and I got into this trouble where shouldn't that trigger self-employment taxes for the child, even though it's under 12,400?
Well, if the child has a Schedule C, even if it's under 12,400, they have a filing requirement. Then
Right.
yes, it would be.
So it's actually better, Kunal, what I found out is actually better to pay them as employees than to pay them as independent contractors. So that won't trigger the self-employment taxes.
That's absolutely correct.
I had this issue last year, so I
And
ran.
then you have no issue with funding a Roth IRA either.
Right. Yeah, you can put 6,000 away in a Roth tax-free, so that's awesome. How many real estate professional tax returns do you file every year? Reps are real estate professional status returns you file every year. How much, what is the audit rate and success in defending it?
I have not had one audited for real estate professional status yet. So we're really, like I mentioned in my talk today, we're really, really good about documentation. And that's how kind of we make sure our clients keep good records, good documentation. And a lot of my practice is devoted to real estate professionals and investors, a big chunk of it.
What is the tax strategy for short-term capital gains? I know you can do opportunity zone investments. That's one.
There's several actually. You know, you can certainly do opportunity zone investments. Then there is monetized installments, and it depends on how much are we talking, because some of them have costs involved with it. There's deferrals, but monetized installment sale could be
What is that strategy? Monetizing what? Sorry.
monetized installment sale.
Okay, monetized installment sales, opportunity zone investments. I think some kind of energy investments also give you tax breaks on active income, right? Like if you're investing in oil and certain investments, you can get active income. So that actually helps you offset.
And with conservation easements, that will give you a tax benefit too.
Right. So there are like 4 or 5 strategies that will help you offset short-term gain as well as W-2 income. So opportunity zone is one thing I used a couple of years ago to actually offset my short-term gains. I didn't use it for long-term. I just chose to pay the long-term gains, and I used it just instead for my short-term gain portion. So that's not exactly completely getting away from taxes. It's more a deferral strategy rather than.
But there is a tax.
Yeah, there's a step up.
Well, yeah.
There's a basis step up, right? And I think right now it's like 15% or 10%. Yeah, something like that. Yeah. So if I start a new business and have an upfront cost of 45K in the first year with training and education and a 45K profit in year 1 and 2, can the upfront cost negate the profit?
I didn't.
So 45K upfront cost in training and education for starting a new business. And then he makes 45K in year 1 and 2. Can they
Really
pay
the startup costs? If those are really the startup costs, then those get capitalized until you start earning or generating revenues.
So can they offset that startup cost with?
So then the startup costs, then you get to depreciate them.
So you can't just take them off. You have to depreciate the startup cost. Is that over a certain period that you get to depreciate it?
Yes, it is, and I believe that's 15 years. However, if you're a C corp, there's ways around that, and you are able to get a better deduction on that. But if you're a Schedule C, then you kind of have to capitalize the startup costs and then depreciate them or
So you
amortize them.
figure out how you want to organize yourself for tax purposes to get the maximum benefit.
Entity selection is a must, and that's what I mean. There are all these nuances, the different things that go into selecting entity. So there is no one size fit all for that.
All right. The questions keep coming on. Like I just thought I got to almost the end. So when are we on time? We are way past our time.
We're way past time. You know what we can do? If anybody has questions, my email address is on here. Feel free to email, and we'll make sure to respond to you.
Yeah, I can copy and paste, send some of these questions as well if you want to answer them. So we will let people go. I know a lot of people have dropped off already, so we are pretty much beyond our scheduled time. So thank you everyone for joining in. Thank you so much, Angie. This was very useful. I know I have some notes to take away. I mean, some disaster relief, all these things. I've just been jotting it down. So thank you always. Thank you as always, everyone. Okay, the email address is, what's the email address?
Angie, ANGIE at
Mhm.
fin, FINTAX, fintax, CPAS, that's a plural, CPAS.com.
Okay, I just put it in the chat box, Angie at fintaxcpas.com. Please email her, get your questions answered. And also thank you again, everyone, for taking time out. I know it's very late in the evening and you take time away from your families to attend these. So I'm very grateful to you guys to be here. Thank you to Angie for taking time away from her family today to be and talk to us about this. This was very useful. And if you're still a W-2 employee, think about a side gig.
Thank you. It was really fun. I hope everybody enjoyed it and are taking away some good pointers. Love to do this.
And I'll see you guys next week. We have an amazing investment opportunity, so we'll talk more about that. Thank you, everyone.
Awesome.
Have a great evening.
Bye.
Bye now.